So to get your daily buys, you need to understand what is a master range. So now that this swing high is broken, where is the low of the range? Would it be this swing low right here, or this swing low right here, or this swing low right here? And when referencing the master range, you're looking at the last swing low, the lowest low that was created from that swing high that was broken. And in this case, it would be this swing low right here. This would be your master range. Let's carry on. So now that this swing high is broken, where is the low of the range? It will be this swing low right here. So what do we have here? We have this swing high being broken. So now that this swing high is broken and price came back inside, where is the low of this range? Low of this range would be right here. So this would be the high of the range, this current new high, and this now would be the low of the range. So we are currently in our master range. And this is the daily time frame because this is the daily buys. So now that price broke this high, if price comes back inside of this swing high, this would be the bottom of our range. Not this, it would be this swing low right here. Now price came back inside of the range. So now this is our swing low and this is our high. This is our range. We are in our master range. So now price broke our swing low. We're going to see if price does head back inside of the range. Let's continue to the downside. Now this is our swing low. If price comes back inside of this swing low, this would be our swing high. So let's see. Now that price came back inside of our swing high, wood closes outside of the range and inside of the range. This is our high. So this is our master range. And where is price potentially heading? Fair price. And then from fair price, be the extreme. And we'll cover this in a second. So price here reacted from an extreme zone. So now we have a micro break to the upside. So now let's see if our demand holds. Our demand didn't hold. So now this previous range is abandoned. And now this swing high, this swing low was broken. So now this swing high is our master range. Price broke this swing low. So if price comes back inside of this swing low, where is the top of our range? The top of our range will be this high because this low created this high and this high created this break of structure. So now this is our range, this swing low and this swing high. We are operating within our range. Price looking for an extreme level. Reacts from an extreme level. And we will cover this in a second. Now price reacted from both extreme levels and broke structure on this side. So now our master range is this swing low and this swing high that was broken. So again, we're not paying attention to all of these micro swings inside of our range. So now this high and this low is where our range is. So what happened here? Price broke structure, came back quickly. So this would have been our range and then price expanded. So now you might get an overextension all the way to this level right here. So now that price broke structure and came back inside the range, where is our range low? Our range low would be the lowest low. Is how we explained in the first example. This is the high, and now this is the low of the range. Price is at an extreme zone. So an example between historical reference and current reference would be something like this. This initial rejection right here would be based on historic reference. And this micro reaction is based off current reference. So let's differentiate between current price action and historic price action. So historic price action is when you look to the left. So let's say you're trading right here. If you're referencing this demand zone, this would be historical price action. Why? Because you are looking to the left. You're looking further, you're cutting through candles, and you're looking at historical data. When we're talking about current price action is if you're trading right here, this is your current price action. So let's say this is a historical demand. When you're looking at current price action, this will be a current demand. This reaction right here. So let's have a few more examples. So let's say you are looking at a rejection right here. While you're trading right here, this would be historical. This will be historical supply. Now, if you're trading right here, this would be your current price action. This would be current supply. This reaction here would be current supply. Same thing here. This reaction right here, obviously the bottom quarter, this will be historical demand. And this reaction would be current price, current demand, and so on, so on. So again, when you look to the left, when you look further to the left, that would be historical data. When you look at where you at currently, that would be current price action. So I'm sure by now the question is, how can we figure out the daily bias? Now, what we're going to do is we're going to combine everything you learned so far. What we're going to look for mainly is we're going to look for that current price action, that current reference. And what we're going to look for is that demand reaction. Prior to this, we want to make sure we are in a master range. So in this case, price broke structure here. And once price broke structure and closed back inside of this high, we have our master range. And now price obviously retraced to an extreme zone, which is our demand zone again. Actually, let me change this. So price comes back into an extreme demand zone. And I've talked about this multiple times. I could always cover it real quick before the end of this lesson. So price comes back into a macro demand zone based off historical demand. And now what you want to see in your current price action is on the daily time frame, you want to see that current demand. So you'd want to see price react of this current demand. And as far as your signal goes, what you're looking for is, and I mean, again, the same process here. You would treat this as a separate range. You would treat this current price action as a separate range, and you would mark up your demand zone. What you want to see is one of two things. Let's erase this. What you want to see is price react of that demand zone. And as far as your confirmation, you would want to see either a bullish daily candle taking out the previous candle. So a daily candle with a manipulation, with a wick manipulation, and then closing back bullish, or you want to see an engulf, one of the two. Now, let's say this is the case, and up to what point is your bias at a high probability? Up to the opposite extreme. So if you're going from one end to the other end, the top quarter, you have an extreme bullish bias, an extreme high probability bullish bias up to this point, up to the extreme of this current price action. And your final bias would be right here. So of course, nothing is perfect. Nothing works every single time. So we do have an adjustment here. So let's say you not guarantee obviously, but you have a high probability bullish candle. So let's say this next candle is bullish up to this point. But now the next candle reverses. Now the next candle reverses. So what is this reversal? What this reversal is, what you had here in current price action is price went down, price went up, created that demand zone, reacted off that demand zone, came up at the barrier, and then pull back. So when you do see these bearish days, when you do have your bias set, understand that these bullish days are just simply pullbacks. So these bullish days are pullbacks, and what you're waiting for, what happens when you have that bearish day, all you're waiting for is another confirmation, another daily candle. So once you get another, oh man, that was embarrassing. So when you get another bullish day, now that the pullback is done, now you're back to having a bullish bias until your next bearish day. And then if you have another bearish day or multiple bearish days, do understand that this is simply a pullback. This is a pullback, and you're waiting for the bias to turn bullish again so you can take price to your final target, which is this extreme zone. So what you have here is your master range. This is the range that you're operating in. And if you go to the bottom quarter, again, we don't need to pull out the fib every single time. Price is reacting off this zone currently. So this would be the demand zone. Make this a bit lighter. So what are we waiting for? We're waiting for a potential reaction of the bottom quarter inside of our current price action. Let's make this darker. So what do we have here? We have an engulf. This candle, this daily candle completely overtook this next candle. So now we have a high probability bias all the way up to the top quarter. So this is where we have high probability. Now, once price breaks through this level, obviously we're targeting the extreme level here and eventually the external liquidity. But we're basing it off percentage. And if you are in a Discord group, you do know that all the students grade their trades based on LQ, MQ, and HQ. The bias from here to here would be HQ. The bias from here to internal liquidity here, the top quarter, this would be MQ, which is medium. And LQ, low quality, would be taking it all the way to the top. So it's just based on probabilities. That doesn't mean that price wouldn't just rip all the way to external liquidity. Doesn't mean it won't get there, but we are basing it off probability. So we have one day in our favor. Price broke out of this zone, and we did have a rejection here. So we can see that the supply was, in fact, and now you have this pullback. And again, like I explained previously, if you're looking at it from on a lower time frame, what you are seeing is price coming up here, price using that demand, breaking structure, and now this is just simply a pullback. So what are we waiting for again? We are just waiting for a bullish candle. And when looking for that bullish candle post your pullback, you usually won't get that strong confirmation, whether it's an engulf or a manipulation candle. You just simply won't. So what you are waiting for is simply a bullish candle. Now you have a bullish candle. So now your bias is set at a high probability until the top quarter, because you could always find rejection at supplies. Whether the rejection completely takes you down or the rejection breaks, either or, this is a danger zone. So this is why we base it off these levels. You had 1, 2, 3 days in your favor, or now price is finding rejection at the top quarter, like we said previously. So this is why we take precaution when it comes to these levels. And again, if you want to get these levels, you pull out your fib top to bottom, and you'll find that price is reacting of this extreme zone. So this is a pullback. Again, you could simply just wait for a bullish candle. But at this point, it's kind of a low probability. So now you got a bullish candle, and you can set your bias up to this point, and then potentially now that you have clean traffic, so now this zone is clean traffic where there's no orders, you can potentially trade through it. Add one day in your favor. Price finding rejection of the supply, like always. Another bullish candle and another day in your favor. So let's simulate. So now Now price is outside of the range, but now price came back. And where is the bottom of your range? The bottom of your range is this low. So like we explained previously, no need to explain it one more time. So what are we waiting for? We are waiting for a rejection from this zone, from our current price supply. So what did we have here? We had a confirmation, which is an engulf. And in this case, we had another confirmation, which is the manipulation candle. So to what point do we have a high probability bias? All the way to the bottom quarter. So all the way to here. So this is probably just one candle. Okay, this candle went against us. But did price close above our supply zone? Not yet. So we will look for another confirmation. So this could simply just mean a pullback, just how we explained previously. So now you have another bearish candle. Again, to what point is your bias? Your bias is up to the bottom quarter, the bottom demand. So now make it. You have one candle in your favor and price is rejecting of this zone. I'm wondering if this rejection is based out of a demand. Not yet. You have two days in your favor. And now your third day price is reacting off a demand. So this is now pullback. So you're waiting for another bearish day. Price came back again and tested this level, but now gave us a rejection. So now to what point is our high probability bias? All the way to the bottom quarter. So somewhere right here. And again, you do want to be more accurate about this. So I would advise you to pull out your fib and actually mark up your zones. I'm just eyeballing to speed this up. So boom, you had, even though this day was bullish, majority of the volume was to the downside. So you were right. And now price is rejecting off this level. So again, this could be another pullback. So let's see if we can get another bearish day. Now we had another bearish day with a manipulation and an engulf. So we can potentially take price to the right below this level. And this would be clean traffic. So then we could potentially take price down here. Let's mark up the clean traffic. And price instantly closed the clean traffic. So you had a day in your favor. Now we are going through a pullback. So this pullback again, and as you get better with this, you would understand what is the pullback reacting of. So go back in this example and watch it again and look at what are these pullbacks reacting of. You would see a somewhat of a consistency. Now another bearish day, and now price is approaching the demand zone. So you could expect a rejection here anytime. Price is blowing through it. You had another pullback, which is based out of this demand zone. Now you could get another bearish candle. You had another bearish candle. And now we are more of an MQ. If we're still grading our bias, we could take price all the way down here, which is your extreme demand. But at the same time, your probabilities did went down because this is where the high probability, bias was. And your bias was set. So now price is reacting off this demand zone. And now what we could do is we can look for a current price reaction of this demand zone. Let's see. What do you have here? You have a reaction and a manipulation candle as a confirmation. So to what point are you taking price? You are taking price up to this top quarter. So again, how I would mark it would be a little bit lower. This is where you have your high probability bias. And again, any pullback to the opposite direction could just simply mean this is a pullback and price is searching for more liquidity. As long as price doesn't take out this low. If price takes out this low, then it's a change of plan. That was a pullback, and now you have a green candle. And now price closed above the demand zone. So same thing again. Everything that we went through here, same thing. And again, price is reacting from your top quarter, which is your supply zone, and same thing. And again, remember, we are still in our master range. When we were reacting of this zone right here, we were in the master range reacting of this demand. When we were above this price action, once price came down, we are still in our master range. And now price came down here, we are in our master range. Hope you guys enjoyed this lesson. Again, this wasn't my intention to make this video this long, but if you guys do want a follow-up, please let me know in the comments.